First question to you is with regards to margins, because overall EBITDA margins have seen an improvement, and this is on the back of gross margins improving on the back of lower input cost. How sustainable is this EBITDA margin growth that you're looking at?
So Mahima, thank you first of all. I think we are confident of maintaining the EBITDA margins at the higher end of the corridor if the input prices remain benign. And I think, Mahima, we've always maintained a corridor of 20 to 24%. And I think we keep that corridor, especially depending on what the input costs are. Our current understanding of input raw material costs is that they are likely to remain benign, although they have arguably bottomed out in Q3, in my opinion. Having said that, with improvement in mix, with a little bit of pricing, and with our cost effectiveness measures, we are confident to maintain our margins, first of all, in the corridor of 20 to 24%, and arguably a little bit at the higher end of the corridor.
And Sudhanshu, what about the gross margins? Because VAM is that one pain point area which will actually determine your raw material prices going forward. So how are you viewing that dynamics, and this against the competitive environment as well?
Yes, so I think you're absolutely right. So as far as VAM is concerned, in the quarter that's gone by, the three, our VAM prices have been close to about $840. So I think that's been a low, as we are saying. We continue to see VAM relatively benign. I think as we go forward, there could be an impact of rupee depreciation a little bit, which is going to come in as we go forward. But as I was telling you in the previous question as well, that as far as we are concerned, with between our mix improvement continuously between our band pricing and cost effectiveness programs, as long as the raw material is benign, you will continue to see EBITDA margins at the higher end of the corridor.
Got it. So, Sudhanshu, you have mentioned this in your press release as well, and there's early signs of demand recovery, and you expect better demand going forward with favorable monsoons as well. Just want to understand that this, positivity coming in, plus the kind of push that this budget has given with regards to Capex improvement, how do you see this demand coming in from a slightly long-term perspective? Let's say FY27 also down the line, do you expect demand to sustain and grow further?
Yes, Mahima, I think if you look at, one of the reasons, and you talked about it in the beginning, I think the reason that we deliver consistent near double-digit underlying volume growth quarter on quarter, I think is because of the strength of our portfolio. And I think what the union budget has announced in terms of that 12.2 lakh crore on infrastructure spending, particularly I think as it gets into urban infrastructure, there has been a talk of CER, the city economic regions and all that, and also urban mobility, and particular rapid railways. I think all this leads to more urbanization. Urbanization in general is good news for us as a company, because that means more dwellings, that means construction, that means consistent renovation. And between repair and renovation and new construction, I think our portfolio tends to perform very well. As a matter of fact, in the quarter gone by, the two best, very well-performing part of our brands were Dr. Fixit and Roth. And both of these are more our construction brands, what we call construction chemical. So I think this part of our portfolio will continue to grow as we go forward. And we remain very buoyant on this.
And so do you think that, we've been debating about this since the past so many quarters, right? That the rural demand is looking stronger than the urban demand. Do you think that this push by the government will at least reduce the gap between that urban and rural demand, and maybe at some given point of time, let's say 4 quarters down the line, will, completely take over the gap?
No, that's a great question, Mahima. As a matter of fact, if you were to look at our own numbers, I think our rural demand has always been ahead of urban demand. But in the quarter which has just gone by, the Q3 FY26, our urban demand really inched up. It's coming closer to rural. So therefore, we are seeing considerable buoyancy in urban demand as well, and which is good news.
Got it. When do you expect overall revival in your export business, Sudhanshu? Because that is the only pain point right now, that is kind of impacting that growth number. But overall, the business has done so well. So when do you expect a revival there?
Mahima, as far as exports is concerned, our overall share of business of exports to Pidilite is small. But you are absolutely right. In the quarter that went by, quarter 3 FY26, it got impacted, like most other businesses, because of the tariff and all that. I think with the announcement that has just come in, Mahima, a couple of days back on Indian tariffs to US now at 18%, with all the work which is happening on bilateral treaties, Mahima, and especially the EU-India FTA, which has got signed, which will take about a year to sort of fully fructify. I think between the correction on US tariffs at about 18%, with a lot of bilateral treaties that are getting signed, we see our export momentum coming back. As a matter of fact, some of it we'll start seeing towards the end of this quarter itself, but subsequently in future quarters. Because even in our B2B business, Mahima, I wanted to decode that, which is to say that our domestic B2B business has grown at mid-teens. It is our export business which got very adversely impacted in quarter 3. Particularly in quarter 3, it got very adversely impacted. I see that turnaround very quickly towards the later part of this quarter itself. And thereafter, I see it to sort of come back to robust double-digit B2B business, which we were doing.
Oh, interesting. So this quarter end is quarter end or month end, you said?
Quarter end.
Quarter end. Interesting is when you expect the export business to see revival. Okay. So Sudhanshu, with regards to the Capex that you plan going forward in FY27 to 28, what is the intensity looking like? And largely, do you think this will be, on the side of growth oriented, or do you see this more of a maintenance-led Capex that you'll be doing in the next 2 years?
Mahima, that's a great question again. I think as far as we are concerned, it's going to be, and my answer is an and. There will be, so therefore, first and foremost, there will be a lot of growth-oriented Capex. So if you look at one of our fastest growing brands is a tile adhesive brand, Roff. So we will be putting up more plants in the next 2 years for that, because there again, getting the plants close to the market drives demand. In some ways, supply drives demand. So therefore, that's the way. So therefore, we'll continue to expand and drive and put Capex for growth there. Also, some of our other growth categories, you will see a Capex going in. So that's going to be one large chunk. But the other important piece is that we are continuously modernizing and automating some of our plants for our core businesses as well. And I think in the next couple of years, we will have 2 large plants coming up, which will be basically more modern, automated plants for our core business in